Hey everyone, and welcome to This Explainer. Today, we are going to completely demystify stock market volatility. Seriously, if you've ever looked at your portfolio and felt that sudden wave of panic, or if you've ever wondered why on earth a stock drops even when the underlying company is actually doing really well, you are in the exact right place. We're going to logically and mathematically prove exactly why long-term investing absolutely works, and why short-term trading is, more often than not, just a massive illusion.
Okay, so here is our roadmap for today. We'll start with number 1, the stock market master equation. Then 2, short-term speculation and noise. 3, the medium-term bridge to reality. 4, long-term fundamentals and compounding. And finally, number 5, we'll wrap up with the ultimate investing takeaway.
Let's dive right into Section 1, the stock market master equation, the rules of the game. Now, before we even begin to talk about timelines, we absolutely must establish the core mechanics that drive every single stock return you will ever experience. And it comes down to this brilliant formula from Vanguard founder John Bogle. It is the absolute bedrock of our explainer today. Bogle essentially proved that every single return in the stock market can be broken down into just 3 simple mathematical components: dividend yield, plus earnings growth, plus the change in valuation.
Let's break that down, because it's fascinating how this perfectly isolates reality from perception. Your dividend yield, well, that's physical cash placed directly into your hand. It's real money you can go out and spend. Earnings growth is the actual tangible increase in a business's real-world profits. They are selling more things and making more money. But that third variable, the change in valuation, that one is entirely subjective. It is literally just the ever-shifting price tag that other people are willing to attach to those actual profits at any given moment.
We really need to define this third variable crystal clearly, because change in valuation is by far the most misunderstood factor in investing. It's the ultimate driver of market chaos. See, it is driven entirely by human emotion, by speculation, fear, and euphoria. Think of it kind of like buying a house. The house's layout, the foundation, the roof, that's the fundamental reality, right? But a massive, frantic bidding war driven by desperate buyers, that is the change in valuation. Keep this in the back of your mind, because this single, emotional variable is exactly what makes the stock market feel so completely unpredictable.
Moving on to Section 2, short-term speculation and noise. With our foundational equations set, let's see what happens in the short term.
Let's start incredibly small, a timeline of just one single day. When you check your portfolio on a random Tuesday afternoon, what are you actually looking at? Well, the truth is, on a one-day horizon, stock price movements are effectively just random noise. Over a mere 24 hours, high-frequency algorithms, transient liquidity needs, and these immediate knee-jerk reactions to macroeconomic news completely take over the steering wheel. This means the price you see blinking red or green on your screen has almost zero correlation with the underlying company's true economic value. I mean, a company like Apple doesn't suddenly become 5% less valuable as a functioning business on a Tuesday just because the stock price dropped 5%. They didn't fundamentally change their entire business model overnight. It's just that algorithms traded millions of shares in milliseconds.
Okay, let's zoom out just a bit to the 3-month mark, 1 quarter. You might logically think, okay, earnings reports come out quarterly, so reality must set in here, right?
Well, actually, the situation is still heavily distorted. Over a single quarter, investors hyper-focus on Wall Street analyst expectations, specifically these things called whisper numbers. Whisper numbers are basically the unofficial, behind-the-scenes profit expectations that traders gossip about. So a company might have incredibly strong, growing profits, literally generating billions in actual cash, but if those profits slightly miss this totally made-up expectation by just a single penny, the stock gets severely punished. In this short time frame, the actual physical profit matters way less than the mere expectation of that profit.
Now, expanding our horizon to 1 full year. This is where we hit peak volatility.
This 1-year time frame is honestly what completely derails most novice investors. In any given year, stock returns rarely, if ever, actually hit their historical average. Why? Because that third tricky variable from our master equation, the change in valuation, completely dominates the narrative. Whether central banks are tweaking interest rates or sudden panic causes a valuation collapse, the multiple just swings wildly. Investors might suddenly decide they're willing to pay 30 times the company's earnings instead of 20 simply because of AI hype. And that drags prices up or down entirely regardless of what the actual businesses are doing on the ground.
Which brings us to Section 3, medium term, the bridge to reality. The most crucial point of this whole explainer is understanding what happens when we finally push past that chaotic, emotion-driven first year.
This is where we see an absolutely brilliant paradigm shift. In the short term, the market acts like a psychological voting machine. It's a popularity contest, driven by sentiment and external shocks. But as we transition into the medium term, all that speculative noise mathematically begins to cancel itself out. The market transforms into an economic weighing machine. Think about it. A scale doesn't care about popularity or hype. It only measures heavy, tangible mass. And in the stock market, that mass is actual, physical business profit.
So at the 5-year mark, the landscape shifts.
Over 5 years, the actual business cycle takes over. Sure, recessions might cause temporary dips, but true enterprise growth becomes your primary engine. If a company consistently grows its revenues and profit margins over half a decade, its stock price will almost certainly follow suit. Meanwhile, all those wild, speculative valuations from the 1-year mark, they begin to act exactly like gravity. If a stock was totally overhyped and floating away like a helium balloon, reality acts as an anchor, pulling it right back down to its actual earnings. This is where returns finally begin to naturally smooth out.
Section 4. Long-term fundamentals and compounding. We are now entering the era where human emotion, algorithmic trading, and those silly quarterly surprises are completely, mathematically erased from the equation. When we stretch our timeline to a full decade, 10 years, the mechanics of investing transforms so completely that the market ceases to look anything like a chaotic casino. Instead, it finally reveals itself as a highly reliable engine of massive wealth creation. When you look at the drivers of return over a 10-year stretch, the impact of valuation changes shrinks down to just a tiny sliver of the whole picture. Over a decade, a company's ability to efficiently reinvest its cash, generate high returns on capital, and compound wealth internally accounts for the vast majority of your return. It's the ultimate snowball effect, profits generating more profits year after year until the sheer size of the business completely crushes any leftover short-term market panic. Fundamental economic reality becomes your impregnable shield. Finally, let's extend our horizon out to 2 full decades, 20 years. At this extreme scale, even specific top-tier products and massive macroeconomic cycles come and go.
So what actually drives your returns here? Well, because any given product can become totally obsolete over a 20-year stretch, the ultimate driver of relentless earnings growth and generational wealth becomes entirely dependent on the intangible qualities of a business. It comes down to a company's culture, its leadership, and its sheer adaptability. Think about how Apple seamlessly transitioned from iPods to iPhones to digital services over 2 decades. That wasn't just one lucky product. It was a deep, organizational culture of adaptability driving those core fundamental variables we talked about at the very beginning.
And that leads us to Section 5, the ultimate investing takeaway.
By completely understanding this chronological progression from a chaotic one-day illusion to a concrete 20-year reality, we arrive at the definitive rules for mastering your portfolio. To invest successfully, you absolutely must match your expectations to your timeline. Step 1, you've got to stop panicking over one-day or one-year valuation fluctuations. They are just noise. Step 2, do not attempt to predict short-term market movements because missing just a few of the market's best days will severely devastate your long-term results. And step 3, adopt a passive buy-and-hold strategy to capture the immense compounding triumph of long-term human innovation.
We have mathematically proven today that short-term volatility is just a harmless illusion. It's a mask hiding long-term economic certainty. It's simply the change in valuation versus the actual real-world earnings growth. So as you look at your portfolio tomorrow, the only real question left to ask yourself is this: are you going to gamble your wealth on the one-day illusion, or are you going to invest it in the 20-year reality? Thank you so much for joining me on this explainer. I really hope this structural breakdown has completely shifted the way you view the market. Keep learning, stay entirely focused on the long game, and I'll catch you on the next one.